It's quite a puzzle to solve. The fact that we've still got strong economic growth, we've got a re-acceleration in hiring by employers, yet we've got inflation coming down. Is this just the bottlenecks clearing out, but we still have a very underlying strong demand story?
Good morning, Karen. I think that what we are seeing right now is an environment in which the economic data is showing still the effects of the stimulus packages and the accumulation of debt. This is very important. The consumer growth is actually robust, coming fundamentally from entertainment, and that comes from higher credit card debt. Therefore, the weakness is likely to be ahead. And I think that that's what the Federal Reserve is also going to face in the next 6 to 9 months, is that the lag effect of monetary policy has not manifested itself yet in the economic data. We have a very risky accumulation of debt in the public sector, obviously with a rising level of indebtedness that was not anticipated by the administration itself in a year of growth, and an increase in debt coming from families. Those two elements are likely to hit the economy in the next 9 to 12 months. So I think that what we are likely to see is a significant slowdown, and the Fed is preparing itself for it. I think that that's why the market expects rate cuts in the second half of 2024.
It's almost as though you've stubbed your toe, you know it's going to hurt at some point, and you're waiting for the pain to catch up. So when you look at market pricing down, the 85 basis points that the market is now anticipating in terms of rate cuts, despite this message from the Fed that they may not be done on the rate hikes, are you saying that the market is not mispriced, that they are actually right in their assumption there will be rate cuts next year?
I think that the market is right in the thinking that there will be rate hikes next year. It is probably too optimistic about how large those rate cuts will be. And the reason is because the economic data is very likely to get a little bit worse, but not massively worse, with all of the different elements of growth that continue to support the U.S. economy. So the biggest risk, I think, is being too optimistic in thinking that, on the one hand, the economy is not going to get drastically worse, and at the same time expecting such a large level of rate cuts. So that doesn't compute. What I think is more likely is that the Fed cuts rates as the economy slows and employment starts to get worse. However, that the rate cuts will be much more prolonged throughout time, for a very simple reason, is that at the same time it looks like inflation is going to be persistent. So it's a very delicate balance. It's not easy to achieve a soft landing, but so far what the Fed is doing is the logical step, and what needs to happen in the next few months is to watch how it affects the real economy.
Dan, if the Fed was to, they're saying that they're not sure if they're actually sufficiently restrictive at these current levels. So if they were to hike again, one hike wouldn't do the trick, surely, would it?
Absolutely right. If they have to hike rates, it is because, on the one hand, aggregate demand is not falling as a soft landing would indicate. And on the other is because inflation remains not just persistent, but that actually it starts to creep up in 2024 as the base effect stops working. Therefore, just one rate hike will not work in that scenario. I think that if we look at monetary aggregates and we look at the slowdown of economic data in the private sector in particular, it looks very difficult to see a massive increase in inflation next year. But obviously the Fed would not be happy with just one rate hike if inflation rises in 2024. The risk of that happening right now is actually 50-50.
Dan, I want to get your thoughts then on, the kind of conversations we have been getting as well then, even from Druckenmiller, who is speaking just really about how even Janet Yellen should have played perhaps a better role when it comes to the economic stance in the U.S. and has left the Fed perhaps in a precarious situation. I mean, I don't know what your thoughts are with regards to that. Has the Fed only got one tool, unfortunately, and now the economy has to play its role, and that may not necessarily be up to them?
I think you're absolutely right. To start with, this is the first time in recent history in which monetary policy and fiscal policy are going in separate ways. Monetary policy is restrictive, fiscal policy is exceedingly expansionary. So obviously, you cannot reduce inflation if government spending and deficit spending continues to be very aggressive. The anti-inflation measures that have been implemented in many cases have actually cemented and perpetuated high inflation, because it means more artificial demand, if we could say. So one of the risks here is that when fiscal policy is going one way and monetary policy is restrictive and going the other way, the entire burden of the monetary contraction is on the shoulders of the private sector, consumers and businesses. And that is actually the biggest risk, because if the economy turns, the impact will be much larger, as we are already seeing it, for example, in tax receipts. So, yes, right. The government and the Treasury should have been significantly more prudent in terms of fiscal spending.
Right. Dan, I want to get into what this means for earnings, because we're coming up to a final quarter where we're seeing a rapid reduction in some of those earnings estimates. What do you think the final quarter looks like? Do you think we're going to get any form of a market rally?
I think we will likely get a market rally coming more from monetary policy than earnings. I think that earnings are likely to be largely disappointing, particularly on the margin side, because of elevated inflation and because of the weakness in the cyclical side of the economy. And that at the same time, it's going to be very polarized yet again. We are going to have a very small number of companies beating estimates by a very wide margin, and the vast majority of the S&P 500 companies actually slightly delivering on EPS, but missing on sales, and with a less than, let's say, optimistic outlook on growth of earnings. I think that the biggest risk in earnings estimates is in 2024. The fourth quarter is likely to be similar to the third quarter so far, in which the market reacts positively to EPS beats that are robust and coming from ordinary results. But the fourth quarter is likely to be weaker, and the 2024 as well.
Dan, thank you so much for spelling it out for us. Dan Lacalle with us, Chief Economist at Tressis Gestian.